On average, people aged 18 to 21 in the UK have between £1,000 to £2,000 saved. That's not much, but it's also not surprising. Life's expensive. But if you want to be above average, you've got to make your money work harder. And that's where stocks and shares ISAs come in. What even are they? They're basically a type of savings account in the UK, but instead of earning tiny interest like you would with a regular savings account, you're investing. You could put your money into things like stocks, bonds, funds, and other investments. And the best part is that you don't pay any tax on your profits, no income tax, no capital gains tax, and no tax on withdrawals. As of recent rule changes, you can open multiple stocks and shares ISAs in the same year. However, the total contributions across all ISAs, which includes cash ISAs, stocks and shares ISAs, lifetime ISAs, etc., must not exceed the £20,000 annual allowance. So who can invest? Anyone can invest as long as you're over 18 and live in the UK. You don't need to be rich or a financial genius. Some platforms let you start with as little as £1. The key thing is to start early no matter how much you have, because compound interest really works its magic with time. Now let's go through the advantages of stocks and shares ISAs. Tax efficiency. It protects your investment returns from income tax and CGT. Flexibility. You can choose from a wide range of investments and adjust your portfolio over time. Potential for higher returns. It offers the opportunity for higher returns compared to a savings account, though with higher risks. Accessibility. You can withdraw money at any time without penalties. Transfer options. You can transfer funds from a cash ISA to a stocks and shares ISA or between providers without affecting your annual allowance. There are a few disadvantages as well. They include the risk of loss, as investments can lose value due to market volatility. Provider failure. While your investments are protected up to £85,000 by the Financial Services Compensation Scheme for certain provider issues, this does not cover market losses. Fees. Providers often charge fees such as platform fees, transaction fees for buying or selling assets, and fund management fees if you invest in managed funds. And lastly, complexity. Managing investments requires some knowledge or reliance on professional advice, which can incur extra costs, but not to worry because that is why I am here. Right, let's quickly cover the basics. What are stocks and shares? Stocks are essentially ownership in a company. When you buy a stock, you're buying a little piece of that business. Shares? That's just what we call the individual units of stock. If the company does well, your stock could go up in value. If it doesn't, well, your stock could go down too. There are certain types of investment types you can make, and these typically are bonds, ETFs, stocks of individual companies, and investment trusts. I'll explain each one in detail. Bonds are like loans to a company or a government. When you buy a bond, you're lending money to the issuer, and they promise to pay you back with interest. Bonds are generally considered a safer investment than stocks, but they also tend to have lower returns. ETFs, also known as exchange-traded funds, are like baskets of stocks or bonds. They track a specific index like the S&P 500, which is a group of 500 large companies in the US. ETFs are a good way to diversify your investments and get exposure to a wide range of stocks or bonds. Stocks of individual companies represent ownership in a company. When you buy a stock, you're buying a piece of the company. If the company does well, the value of your stock may go up, but if it does poorly, the value of your stock may go down. This can be considered quite volatile and risky, so do your own research. If you want a video on how I do my research for stocks of individual companies, then let me know in the comments. And finally, real estate. This can include buying property to rent out or investing in real estate investment trusts, which is what you would do in the case of a stocks and shares ISA. Now that we've learnt the basics, it's time to explain the how. You first open an ISA through a broker of your choice. Make sure to look at all the factors like fees and the user interface. Now decide on your investment strategy. Do you want to take on the DIY approach where you choose your own investments like stocks and ETFs? Or do you want to take a more managed approach where you use a ready-made portfolio tailored to your risk tolerance and goals? This is something for you to think about. Is it right for you? Stocks and shares ISAs are great for long-term growth and making the most of tax benefits, but they're not without risks. If you're comfortable with ups and downs in the market and want better returns than savings account, they are a solid option. If you're risk averse or need money in the short term, you might want to stick with a cash ISA or other low risk alternatives. If you found this video helpful, don't forget to like, share and subscribe. Start your journey today because the best time to invest was yesterday and the second best time is now. See you in the next video.